If you've ever dipped your toe into the world of investing, chances are you've heard of the name Vanguard. They're known for their low-cost ETFs and index funds and make it super easy for the likes of beginners to get involved with investing. If you're new to investing, think of an ETF or an index fund as a basket of assets rather than owning one individual share of a company. With an ETF or an index fund, you're essentially owning a small portion of all the different assets or companies within that one fund. The reason these are so popular is because essentially with a click of one button you could own a small portion of hundreds or even thousands of companies, and it also helps mitigate risk. So with that said, today we're diving into 3 of the best Vanguard ETFs that you should consider adding to your portfolio. These are going to be aimed at UK investors, but I've also dug out the US equivalents if you did happen to be watching from across the pond. First up, we have the Vanguard S&P 500 ETF with the ticker symbol VUSA. This ETF, as you'd expect, tracks the S&P 500 index, which will provide you exposure to the top 500 publicly traded companies in the US, making it an attractive option for those looking to invest in the US market. You can expect to find giants such as Google, Amazon, Microsoft, and even Meta, all of which are high-growth, innovative companies. Adding exposure to companies such as these within your portfolio can lead to some really great growth. You can see here on the screen how this ETF is weighted. With no surprise, it has a strong lean towards the technology sector, with the remaining sectors being fairly evenly split. This is great in terms of diversity, as it means all your investment isn't riding on the success of one particular sector. At the time of filming, VUSA also pays a dividend. Granted, it's a really small dividend at just 1.03%, but it's a dividend nonetheless. For simple maths, if you had £10,000 invested, you'd expect to see an annual dividend total of around £103. The annual dividend on this particular ETF is split out and paid quarterly, so you could expect to receive around £25 every 3 months. It's worth noting that dividends are not guaranteed. This could go up as well as it could go down, and it could be taken away altogether. It's always something to keep in mind. It's worth mentioning at this point that Vanguard also offer what we call an accumulation version of this ETF. Simply put, this means that you won't get paid a dividend. Instead, in the background, this dividend is automatically reinvested. The ticker symbol for this is VUAG, and if you're looking for an entirely hands-off approach and not wanting to manually reinvest those dividends, this is the one I'd opt for. Now with any ETF, there's always fees to pay for owning that ETF. The great news is that this ETF has one of the lowest fees in the market at just 0.07%, meaning for every £10,000 you have invested, it'll cost you around £7 per year. It's all looking quite good so far, isn't it? We've got exposure to some of the biggest tech companies in the world, we've got low fees, and we've also got an annual dividend. It's about time we look at some of the past performance. Over the past 10 years, this ETF has had an average rate of return of around 12% per year, which is huge when you compare the average savings account today provide an annual return of around 4%. You're essentially 3xing your money over a simple cash ISA. On the graph here, we can see the performance if you'd added a lump sum of £10,000 into this ETF 10 years ago. Today you'd have just shy of £33,000, and that's not from adding any more money in. It's worth noting here that past performance isn't a clear indicator of what might happen in the future, despite these great returns. Your investment in the future could go up and it could even go down. It's just worth noting that. To give you a bit of an insight on this, going back to the graph here, if you were unfortunate enough to invest in January of 2020, by March 2020, the COVID pandemic had hit and impacted the stock market drastically. You can see here on the graph you would have lost a considerable portion of your investment. What was around £17,500 here would have run down just to £14,000 in the space of 3 months. What this graph does show though, is that if you'd have stayed invested throughout the market decline, the market did recover and you'd have benefited from some great gains later in the year. If you're watching from the US, the US equivalent to this ETF is VOO. VOO is listed on the New York Stock Exchange and it's also listed in dollars. Otherwise, they're completely identical. Now at this point, you may be thinking, I'll pour all of my money into this ETF and then one day I'll retire rich. That's one way of looking at it, but there's one big problem with that plan. All of your investment would be riding on the US market, and we've seen this market fly as well as we've seen it crash. So adding some diversification within your portfolio is something you should consider. This next ETF might just help with that. Next up, we have the Vanguard FTSE All World ETF with the ticker symbol VWRL. Where the previous ETF focuses on 500 US companies, This ETF casts a much wider net and incorporates 50 countries. This is made up of large and mid-cap companies within both developed and emerging markets. That detail is quite key really, because it means you're not only investing in fully developed companies that might have already experienced most of their growth. Instead, you're also investing in some of these smaller up-and-coming companies, and that's where a lot of the growth can come from. This ETF holds 3,717 different companies. You're essentially owning a piece of all those companies at the click of a button, making it extremely easy to invest for beginners. This still has a large portion weighted towards the US, as you can see, but unlike the previous ETF, the US exposure only amounts to around 65% of the overall companies. The remainder is split across Europe, Pacific, emerging markets, and even a small portion to the Middle East. You can expect to find all the usual big tech giants like the VUSA fund, but sprinkled with some of the largest companies from around the globe. Aside from the likes of Apple, Meta and Microsoft, you've got companies such as Taiwan Semiconductor. You can also expect smaller holdings in companies such as Toyota from Japan, and even a few holdings from the UK, such as AstraZeneca and Shell. Where sector is concerned, you can see here that it has a strong sighting towards technology, with the others being fairly evenly split out. This further helps with spreading your investment out and adding diversity into your investment. This ETF also provides a dividend. At the time of filming, VWRL pays a dividend of 1.51%, which is higher than VUSA. If you had around £10,000 invested, you'd expect to see an annual dividend total of £151. Again, this dividend is paid out quarterly over the year, so you could expect to receive around £37 every 3 months. Now you can choose what you do with these dividends. I personally buy more stocks with them and essentially reinvest that money, but some people do withdraw this as purely passive income. Similar with the previous ETF, this one also has an accumulation version if you didn't want to manually reinvest those dividends. The ticker symbol for this one is VWRP. Moving on to fees, the fee is slightly higher than VUSA at 0.22%, but I guess there's a cost to having exposure to this many companies. It's still considered a super low fee, so I wouldn't worry too much about this. So going back to our £10,000 example there, it would cost you around £22 per year to own this investment. But I wouldn't worry too much about that, given that you're going to get around £151 per year in dividends. Now let's look at how this ETF has performed in recent years. Over the past 10 years, this ETF has returned an average of just under 9%, which is really strong. On the graph here, we can see what would have happened to your money if you'd have invested £10,000 10 years ago and left it invested within this ETF. Today, that £10,000 would be worth just over £23,000. Which I personally would be really happy with. This ETF for me captures everything. If you're looking to invest in the stock market with as little work as possible, this is the ETF I'd be opting for. You haven't got to worry about juggling different stocks and ETFs. With this one, you could be quite comfortable investing month after month and watching that investment pot grow. Now there isn't a direct equivalent to this ETF for US investors, but the closest one I could find was VT. So make sure you take a little look at that one. Both of these ETFs so far have been great options, but they either have full or a majority portion leaning towards the US market. If you're looking for something outside of this, then this next one might be perfect for you. This next ETF is the FTSE Developed Europe, excluding UK ETF. The ticker symbol for this is VERX. You may have guessed it by the name, but this ETF contains 435 companies in developed European markets, excluding the UK. Now for me, I think this is a great addition to any portfolio. If your portfolio has quite a strong leaning towards the US market, this may be a great one to add in to help rebalance. Around 60% of the portfolio is invested in France, Switzerland and Germany, while half of the portfolio is invested across the industrial, financial and healthcare sectors, which again helps diversify when compared to the previous ETFs which had a strong holding in the technology sector. Perhaps not filled with quite as many glamorous companies like the previous two ETFs, this ETF's 3 largest holdings are Nestlé, ASML and Novo Nordisk. Another great factor of this ETF is the dividend. When compared to the previous 2 options, this ETF provides a dividend rate of over double that of VUSA. At the time of filming, the dividend yield is 2.71%. Using the £10,000 example, you'd expect to receive around £271 in annual dividends. Again, this dividend is paid out quarterly, so you'd expect to receive around £68 per quarter, based on that £10,000 investment. Just like the previous two ETFs, this one also has an accumulation version. The ticker symbol for this is VERG. When it comes to fees, the rate is super low with this ETF at just 0.10%. So for me, this is really starting to tick a few boxes. Moving on to past performance, let's see how this stacks up against the previous two ETFs. Now this ETF hasn't been established as long as the other two, so I can only base the performance over the past 5 years instead of the past 10 years. In that time, this ETF has returned an average of just under 10% per year, which is really strong. On the graph here, we can see what would have happened to your money if you'd invested £10,000 just 5 years ago and left it invested. Today, that £10,000 would be worth just over £16,000, which is really impressive given the little to no work involved to achieve this. The closest ETF I could find for US investors was one called VGT. Now the key difference with this one is that it does include a small portion within the UK market. So there you have it, 3 of my favourite ETFs from Vanguard. If you're looking to invest in these ETFs, then make sure you make the most of your stocks and shares ISA. You get a £20,000 allowance each year, and it'll also shelter these investments from taxation. Let me know in the comments if you're planning on adding any of these to your portfolio. I'd also be keen to learn which ETFs you think should have made the cut within this video. If you found this video helpful, don't forget to hit the like and subscribe button, it really helps the channel in these early stages. Thanks for watching, and I'll see you in the next one.